Picture this: a young college graduate, Jane, with a meager budget, is determined to start investing. Jane's story is an interesting one. She's fresh out of college, armed with a degree, and a burning desire to make her mark in the world. But there's a catch. Her bank account, much like her experience in the world of finance, is quite modest. Yet, she's not deterred. She knows that her lack of funds doesn't have to be a roadblock on her journey to financial freedom. Now, you might be wondering why Jane is so eager to dive into investing when her budget is tighter than a hipster's skinny jeans. Well, here's the thing. Jane understands a fundamental truth about investing. Starting early is key. No matter how small your budget, the sooner you start investing, the more time your money has to grow. It's like planting a tree. The best time to plant a tree was 20 years ago. The second best time? It's today. Jane's story isn't just a tale of determination and ambition. It's a testament to the power of small budget investing. You see, it's easy to think that investing is a game for the wealthy, that you need a thick wad of cash to even get a seat at the table. But that's a myth. Investing is not about how much money you have, but how smart you are with what you've got. It's about making your money work for you, no matter how small the amount. Jane's approach to investing is not only feasible, but smart. She's proof that you don't need a fortune to start building one. She's a reminder that every investment journey begins with a single, often small, step. Just like Jane, you may not have a lot of money right now, but that doesn't mean you can't start investing. The journey of 1,000 miles begins with a single step, right? So, how can someone with a small budget start investing? It's actually quite straightforward. Imagine our friend Jane. Jane is a beginner investor with a small budget. Jane is smart and she knows that the key to successful investing starts with a bit of research. She's looking for investment platforms that are budget-friendly. Jane is not jumping headfirst into the unknown. Instead, she's taking her time, comparing different platforms, and considering factors like minimum investment requirements, transaction fees, and the range of investment options available. Now, Jane understands that investing is not about instant riches. No, Jane knows it's about balancing risk and reward. She understands that all investments come with some degree of risk, so she's not going to put all her eggs in one basket. Jane is looking for a mix of investments that balance her tolerance for risk with her desire for returns. This is called asset allocation, and it's a crucial step in Jane's investment journey. But Jane doesn't stop there. She knows that diversification is another important element of investing. She's not going to invest all her money in a single stock, no matter how tempting it may seem. Jane knows that if that one stock tanks, her entire investment could go with it. So instead, Jane plans to spread her investments across different sectors and asset classes. This way, if one sector or asset class underperforms, the others may help offset the loss. Jane's approach is a great example of how to invest with a small budget. She's doing her research, understanding the balance between risk and reward, and diversifying her investments. Jane is not looking for a quick buck. She's looking at the long term, and she's making her money work for her. See? It's not rocket science. With the right platform, a clear understanding of risk, and a diverse portfolio, even small budget investors can make their money work for them. Choosing the right platform is key for anyone, but especially for beginner investors with a small budget. Now, imagine you're Jane. Jane has a limited budget, but she's determined to invest wisely. She's looking at different budget-friendly platforms. Let's walk through her decision-making process, shall we? First up is the world of robo-advisors. These automated platforms use algorithms to manage your investments. It's like having a robot butler handling your stocks and bonds minus the silver tray. They require low minimum investments and offer low fees. For Jane, this is a cost-effective way to dip her toes into investing waters. Next, Jane examines peer-to-peer lending platforms. These platforms connect borrowers with investors directly, cutting out the middleman. Picture it as a digital handshake between Jane and a borrower. The returns can be attractive and it's fairly straightforward. But remember, it's a handshake, not a pinky promise. There's always a risk of default, so Jane needs to tread carefully here. Moving on, Jane explores online brokerages. These platforms allow you to buy and sell a wide range of investments, from stocks to ETFs. It's like a candy store for investors, only instead of sugar rushes, you get potential returns. Some online brokerages offer commission-free trades, making them a sweet deal for someone on a budget like Jane. Lastly, Jane looks into micro-investing apps. These platforms let you invest spare change by rounding up your purchases. Imagine every time you buy a cup of coffee, you're also investing a few cents. It's like feeding two birds with one scone. These apps can be a great way for Jane to start investing without feeling the pinch. In her journey, Jane discovered that each platform has its own advantages and potential drawbacks. It's not about finding the best platform, but rather the one that fits her budget, risk tolerance, and investment goals. By choosing the right platform, small budget investors like Jane can maximize their returns and minimize their risks. So, are you ready to embark on your own investment journey? Once you've chosen the right platform, it's time to build a diverse portfolio. Picture this: you're at an all-you-can-eat buffet. You wouldn't fill your plate with just spaghetti, would you? No, you'd probably get a little bit of everything. The same principle applies to investing. This is what we call diversification. Diversification is essentially the practice of spreading your investments across various assets or asset classes. It's like putting your eggs in different baskets. Why? Well, if one basket breaks, you don't lose all your eggs. In investment terms, if one sector of the market takes a hit, not all your investments will be affected. So how do you diversify your portfolio? Let's use Jane as an example. Jane wants to start investing with a small budget. She decides to split her investments into three main categories: stocks, bonds, and real estate. Within these categories, she further diversifies. In the stock market, she invests in different sectors such as technology, healthcare, and consumer goods. For bonds, she chooses both government and corporate bonds. And in real estate, she invests in a real estate investment trust, or REIT, which allows her to invest in property without the need to buy an actual house. Now, Jane's investments are well diversified. She's not overly dependent on one sector or one type of investment. If the tech sector suffers a downturn, her healthcare and consumer goods stocks, along with her bonds and real estate investment, can potentially offset the loss. Remember, diversification doesn't guarantee profits or protect against all losses, but it can help manage risk and reduce the potential for large losses. It's like having a safety net. So, what are the benefits of diversification? There are three key benefits: risk management, potential for higher returns, and the ability to capitalize on different sectors' growth. In essence, diversification is a cornerstone of prudent investing. It's the financial equivalent of not putting all your eggs in one basket. And who wants to risk all their eggs? A diverse portfolio is a strong portfolio. It's your best defense against market volatility. Now that you've got your diverse portfolio, how do you ensure it grows sustainably? Well, that's the million-dollar question, isn't it? But don't worry, we've got you covered. First off, let's talk about regular investing. You know, the slow and steady wins the race kind of thing. Well, it's not just an old saying, it's the truth. Regular investing is all about discipline. It's about putting aside a portion of your income every month into your investment portfolio. This approach, also known as dollar-cost averaging, can help you take advantage of market fluctuations without trying to time the market. Let's take Jane for instance. Jane isn't a Wall Street wizard. She's a regular Joe, or Jane in this case. Jane puts aside $50 each month into her investment portfolio. Some months the market is up and some months it's down. But Jane? She's consistent. And over time, this consistency pays off. Jane sees her portfolio growing steadily, proving that you don't need to be a Wall Street hotshot to have a successful investment strategy. Next, let's talk about rebalancing the portfolio. This is the act of adjusting your portfolio to maintain your desired level of risk. If one of your investments is doing particularly well, it might start to take up a larger chunk of your portfolio, increasing your risk. By selling off some of this investment and buying more of others, you can keep your portfolio balanced and your risk level in check. Finally, stay informed about market trends. You don't need to become a financial news junkie, but keeping an eye on major market trends can help you make informed decisions about your investments. Investing isn't a get-rich-quick scheme, it's about consistent growth over time. And with these tips, even small budget investors can see significant returns in the long run. So keep investing, keep balancing, and keep learning, folks. Remember, the tortoise did beat the hare. And in the world of investing, slow and steady really does win the race.